This is scary. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, despite the fact that the government continues to report that the U.S. labor market is strong and robust on continued hiring, I'm going to show you the frightening truth that nobody's talking about, because as you're about to see, millions of Americans will soon be out of work. Plus, we have a sponsor for today's show. We'd like to welcome Mira Pharmaceuticals back. You can find them on the NASDAQ under the symbol MIRA. And we featured them back in February when we put a lofty target on their stock, and the stock has gone up five-fold since. I'm going to show you those charts, plus why Sachs Small Cap Research is saying that Mira is the stock you want to own. I'm going to show you why they believe that you can make a fortune investing in Mira. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg, where we picked this story up. As U.S. small business optimism declines in the most in over 2 years. And this is a big deal because the lifeblood of the U.S. economy is small businesses. They create a massive amount of jobs, but one of the problems is when the economy slows down, they don't have the cash, they don't have the credit, and they don't have the order book to sustain their workforce. So when things start to get bad for small businesses, we know now it's only a matter of time before millions of Americans hit the unemployment line. The National Federation of Independent Business Optimism Index dropped 2.5 points, the most since June of 2022, to 91.2 last month. The decline erased nearly half of the advance over the previous 4 months. And as we talk about, a soft landing narrative here, that the Fed has really engineered the impossible, and that in a matter of a couple of weeks, we're going to get some rate cuts and everything's going to change for the economy. What we're now seeing from small businesses, at one point, they were buying into that view. Now they're not, and that's a huge problem for the U.S. labor market. As 8 of the 10 components that make up the index weakened, led by a 9-point slide in sales expectations. Some 37% of firms reported deteriorating earnings, the largest share since 2010, as elevated prices, interest rates, and labor costs continue to take a toll. But there's a part that they're not mentioning here, is it wouldn't be an issue. They would still see their earnings grow, that the numbers they need, if people were out spending and consuming. That's the issue here. They're not. Because when we look at corporate profits after tax, shown in blue, on a year-over-year rate of change against the U3 unemployment rate, what do we see? There's a typical trend is that when corporate profits start to slow down, you can see that happen here in the kind of late 1980s. What happens then is people get sent to the unemployment line and they get stuck there as the unemployment rate rises. We see the same effect going into the dot-com bubble. We see it again in the global financial crisis, and we're starting to see the early signs of it. Now, it didn't happen as we headed into the pandemic, but we know that the cycle was indeed coming to an end. But this is everything to do with the fact that companies don't have infinite piles of money to keep people around. So as demand goes down, they work through their backlogs, they have a lack of new orders, and then they build up inventory, which is exactly what we're seeing in the U.S. economy right now. Well, the only other choice they have is to lay people off, to cut hours, and now small businesses are starting to raise the red flag. And among those reporting lower profits, 31% blame weaker sales. There you have it. There isn't the demand there at higher prices, and that's exactly the issue here. We talked about in yesterday's show how we saw in China and how we're seeing in the U.S. and in Europe that wage growth is sagging, it's slowing. And what that means is consumers cannot afford higher prices. This is an issue because it means to less sales. When you have less sales, of course, you don't need as many employees. And 17% said the decline was due to prices of materials, again suggesting that they can't pass on higher costs. Labor costs were cited by another 13%, and nearly a quarter of business owners indicated inflation was their single most important problem, well above the 3% long-term average from 1986 to mid-2022. Again, it's all coming back to the fact that there isn't enough money in the economy to sustain higher prices. And this is exactly what happens when you see the political elites at the central banks invert the yield curves and the money curves, and it constricts the creation of credit. At some point, things start to slow down, and we're seeing it happen in small businesses which don't have the resources to keep employees around. As a result, small companies dialed back hiring plans, and that 13% of owners said they still plan to create jobs in the next 3 months. That's down 2 percentage points from the prior month. I don't believe that that number is going to hold. I believe in the next 3 months, we're going to see that number go negative as small businesses are forced to lay people off, which is exactly what we saw during the ADP report. They noted that small businesses were one of the bigger employers that were laying off people. It's only going to get worse because when we look at advanced retail sales, we see demand coming into small businesses. When that declines, they're forced to lay people off. And again, we look at the unemployment rate here. You see slowdowns in retail sales tend to lead to an increase in people losing their jobs and getting stuck on unemployment. We see that again going into the global financial crisis, and we're starting to see the early signs of that now, which is exactly what the report is telling us, is that we see small businesses raising their prices because they need the revenue, and consumers continually say, I can't afford it. But the problem is the cost to the small business in terms of goods and employees is still high. They're getting squeezed at the margin. At some point, layoffs are coming in a huge way. And the NFIB's uncertainty index rose 2 points to the highest since October of 2020. Remember, we were in the late stages of the pandemic. What it's telling us is despite what small businesses are saying, they're absolutely not confident about the economy or their business prospects going forward. And for good reason, because we're seeing a shift in consumer spending habits that's only going to get worse. Consumers shift spending to pay for basic staples, this according to Citibank's CFO, and this is not a good sign because the bank is seeing some underlying problems as consumers run out of money. The nature of spend is evolving. It's going from discretionary to a more staple type of spend. And this is only because people don't have enough money. Now, in a perfect world, there will be enough money and people will be able to buy the things they need and the things they want. But when you don't have enough money, you focus on the things you need and forget about the things you want. And that's the issue here, because look at this. Net credit losses have climbed in Citi's large credit card business, and payment rates have started to come down a bit, they noted. And that's within range previously discussed by the firm. But the problem now is more affluent customers are driving much of the spending growth. So what they're suggesting here is that people are falling behind on their payments. Not the wealthy, which isn't to be expected. It's the middle and lower class. They're running out of money. They're not getting the hours. They're not getting the pay increases. And that means they're starting to fall behind on their debt. And investors are closely watching consumer spending as a factor in predicting how the Federal Reserve will choose to cut interest rates, because there's the belief that that fixes everything. And the notion that people that are in delinquency or moving towards delinquency or suddenly with a couple rate cuts are going to find themselves with a whole bunch of money in their pocket. Well, there's no evidence to suggest that, which is why I said in the months to come, small business owners are uncertainty. It's going to get worse because rate cuts aren't going to make any difference in spending habits. A softening labor market and a decline in the rate of inflation have fueled expectations, yet the central bank will lower borrowing costs later this month to stimulate spending, except it's not going to stimulate anything. Mason said that on a full-year basis, net credit losses look to be about 3.5% to 4% in the company's branded card business and 5.75% to 6.25% in retail services. And this is numbers that we're going to see continue to increase. And what this means is banks are putting more money into reserves to deal with credit losses, and that comes from people entering delinquency and defaulting on their debt. This is not a sign of what you would expect to see during an economy that's experiencing a soft landing. What we should be hearing from the banks is that the credit losses are going down because cash flows are improving. Instead, it's getting worse, and I'm going to show you why it's getting far worse than even most people believe. But let's talk about what's coming for retailers and small businesses as we look back to advanced retail sales, again shown in blue, this against the personal savings rate. And what's critical here is we note that the savings rate is at very low levels, right around 2.9%. And when it gets down to low levels, what happens is consumers start looking at the economy. They see that perhaps the amount of demand at their employer is going down in terms of new orders, that existing work logs are getting worked through, inventories are getting built, perhaps hours are getting cut, coworkers are losing their jobs, friends are losing their jobs, and they start to change their spending habits. One of those things is they start to increase their savings because they realize, what if they're next? They still need to have some money to pay their bills, which is why we start to see the savings rate increase, typically headed into recessions or periods where the economy slows down. We can go back to the dot-com bubble and see how a rise in the savings rate led to a decline in retail sales. We see that happen again going into the global financial crisis. We note that coming out of the financial crisis, we almost had a double-dip recession. You see consumers reacted accordingly. We see it happen again as we started heading into the pandemic, and now with the savings rate at very low levels and retailers struggling, it tells us that the moment consumers stop spending, which may be already happening right now, it means that retailers are in big trouble. Small businesses are going to be forced to lay off. It's going to put millions of Americans on the unemployment line. And we get further evidence that things are getting bad for consumers as now credit card debt unexpectedly soared despite record high APRs as savings rate hit record low. So normally when you see that credit card debt is surging, that means consumers are optimistic and out spending on discretionary goods and services. The problem is it may actually mean that consumers are out of money. And one of the risks that we flagged here, one of the things we were looking for is when banks were going to hit the red line with consumers, when they weren't going to extend any more credit. We thought that could be happening last month, but look at this. We get some blowout numbers in revolving and non-revolving debt just shooting straight up. The question is this going into consumption or is this going just to keep things afloat? The reality is it's the latter. Consumers are falling behind. They're turning to their credit cards now just to pay their basic bills. And looking at the components, a sudden spike in revolving credit was most notable as credit card debt growth suddenly reversed its recent slowdown, which normally is an indication of recession, now surging by $10.6 billion, the biggest monthly increase in February and the second biggest of the year. Now, if this translates into a massive surge in spending, then, well, that changes everything. But reality is, as we head into the corporate share buyback blackout window in the next earnings season, what have we continued to hear in the surveys? What are we likely to hear from CEOs? They're telling us that consumer spending is changing. Their habits are going from discretionary to non-discretionary or staples. What that means is this big surge in credit is an indication that people are running out of money and turning to credit cards just to stay financially afloat. And here we can see that total credit card debt is now at an all-time high, while personal savings rate is at a record low. This is a recipe for disaster. And many people wonder why we face all-time high debts going into recession. Well, because that's how recessions happen. Debt gets built up, the economy slows. Next thing you know, people can't make payments, they enter delinquency, go into default, and next thing you know, the entire economy falls apart. It's all now going to shift. As soon as we see the change in spending going into savings, it's game over for the U.S. economy. Millions of Americans will be out of work. And despite the Citibank notes that their net charge-off ratio is rising, Discover and Capital One are seeing the same things as we come off of those pandemic lows when consumers had money from the government. Now they don't. They're facing higher inflation. They're facing fewer hours. They're facing slower compensation growth. Everything is pointing that consumers are going to see rising delinquencies, and that was echoed in a recent Fed report. As we see headline, inflation expectations are on the rise over the medium term, but here's the big one. Who cares about inflation? When you see delinquency fears unexpectedly hit a 4-year high, it tells you can forget all about inflation. And what this means is that consumers are now increasingly getting concerned that they're going to be unable to pay their bills and they're going to be forced to enter delinquency. And while there was modest improvement in household income expectations, which rose by 0.1 percentage points to 3.1%, remaining within the narrow range of 3 to 3.1 the series has maintained for the past year, there was a very ominous increase in delinquency expectations, which rose again to the highest level since April of 2020. And again, this is coming from people who took the survey. They're saying, look, I can't afford it. I'm going to have to probably enter delinquency at some point on my bills just to get by. This is a huge risk for the U.S. economy because it means discretionary spending is going to plummet, small businesses are going to get hurt, and it's going to lead to more people on the unemployment line in a huge way. In fact, we can look at the effects of inflation against delinquency as we see the consumer price index shown in blue on a year-on-year rate of change against a delinquency rate on all consumer loans. And as consumer delinquencies rise, well, inflation goes away because it means they're not spending on the discretionary side of the economy and even cutting back on the staples everywhere they can. You see this relationship over and over. And while just a matter of months ago, the Fed was worried about rising inflation, the real issue is rising delinquencies is what they should should be concerned about, because what it says is that monetary policy is far too tight here. They made a huge mistake. They constricted the creation of credit. The U.S. economy is running out of money, and that means we're headed to an all-out global financial crisis. And making matters worse, we turn to China, whose exports jumped to the 2-year high in a rare boost for the economy. And I want you to understand how misleading this headline is, because what we know is Beijing pumped its manufacturing base and put money into it to create production and output that's getting dumped around the world. But what the issue here is, it's getting dumped at cheaper prices than what other producers can handle. That's a problem for businesses who are sitting on higher cost inventory. As more goods come into the United States at a lower price, it's flooding the economy. It's going to hurt manufacturers and producers throughout the United States and the rest of the world. And Chinese exports have been a bright spot for the economy, struggling with a housing slump and deflation. However, the influx of cheap goods to global markets, there you have it, has sparked backlash in the U.S., South America, and Europe, casting down on the sustainability of Beijing's growth strategy. And the reality is, it's causing backlash because there isn't enough demand. So when you start flooding the economy with even cheaper goods, it leads to disinflation or even deflationary effects. That means workers in high cost to produce areas are going to face losing their jobs as demand goes down and inventory levels go through the roof. And economic indicators for August so far show the economy struggling to regain momentum after a rocky start to the second half of the year. Factory activity contracted for a 4th straight month, this in China, while core inflation cooled to the weakest in more than 3 years. And this is a problem because we're seeing slowdowns in global manufacturing. Everybody got pumped due to all the stimulus. It caused a surge in demand. And now without all the stimulus, it's creating a giant gaping hole in the manufacturing sector, one of which millions of American workers are going to find themselves out of work, not to mention the millions of workers from all over the world. And vehicle exports have soared to a record as a breakdown of where those cars went isn't available, but it may show Chinese companies are trying to get more EVs into Europe, that's for sure. And overall exports to almost every market grew, with double-digit expansions to the EU, India, and Brazil. Shipments to the U.S. grew at 5.1%, the most since September of 2022, while exports to Russia also picked up to the highest this year. So what you're seeing, China again flooding the global economy, is going to lead to disinflation in a huge way, put millions of people out of work. As we see here, some evidence is EV leases now go to as low as $20 a month to help dealers clear their lots. And this has been an issue with inventory levels. We've talked about how when you see new order growth start to go down and you see backlogs get cleared up and inventories rise, well, what it suggests is that next thing we're going to see is that millions of people are out of work, and this is what small businesses are telling us is coming, and is coming in a matter of months. Now, something we think is about to take off in a big way, and that is the stock for our sponsor of today's show, Mira Pharmaceuticals. You can find them on the NASDAQ under the symbol MIRA. We're going to talk about what's going on at Mira and why Zacks Small Cap Research thinks you can make a fortune by investing in Mira Pharmaceuticals. Let's take a look at what's going on with Mira, because they are a preclinical stage biopharmaceutical development company with 2 neuroscience programs targeting a broad range of neurologic and neuropsychiatric disorders. Mira holds the exclusive U.S., Canadian, and Mexican rights for Ketamir 2, a novel patent-pending oral ketamine analog under investigation to potentially deliver ultra-rapid antidepressant effects, providing hope for individuals battling treatment-resistant depression, major depressive disorder with suicidal ideation, and post-traumatic stress disorder. The U.S. Drug Enforcement Administration's scientific review of Ketamir 2 concluded that it would not be considered a controlled substance or listed chemical under the Controlled Substances Act and its governing regulations. And Mira Pharmaceuticals nears crucial milestone as the submission of its investigational new drug IND application by the end of the year. Let's talk about what's going on with the progress here of Ketamir 2, as recent preclinical studies have demonstrated that Ketamir 2 offers a superior safety profile compared with traditional ketamine, notably avoiding hyperlocomotor activity, a behavior linked to psychotic symptoms, thereby positioning it as a potentially safer option for mental health treatments. The company has further explored the pharmacological profile of the compound in animal models of anxiety and depression. Mira Pharmaceuticals is finalizing its IND application for ketamine 2. The company is also exploring accelerated clinical trial pathways such as orphan indications or cancer-related indications, which could provide faster access to clinical trials and bring ketamine 2 to patients sooner. Mira has strengthened its leadership by appointing Dr. Angel as Chief Scientific Advisor. With over 40 years of experience, including a distinguished career, Dr. Angel was instrumental in the development of regulatory approval of several key drugs such as Ambien, Exadrol, and Myzolin. His expertise in advancing drug candidates for early research through clinical trials is now guiding Mira's pipeline, which is one of the reasons why Zacks Small Cap Research believes that Mira stock is going to skyrocket and potentially make you a fortune as an investor. And here we can see that Mira achieves 100% reversal of neuropathic pain with oral ketamine 2 in breakthrough study, as Mira is optimistic these efforts could demonstrate efficacy in humans as early as 2025. The company remains on track for an IND application by the end of the year. Cash remains solid at over $2.8 million, and expenses remain contained and reasonable for a company in this early stage of development. Let's take a look at what's going on with Zacks Small Cap Report, as their analyst coverage now has a price target of nearly 10x based on the price back in August 23rd of $1.85, setting the valuation, as you can see, at $16.50. The company has two potential groundbreaking therapies and rightly focusing on the one with the potential to get to market the fastest, which is ketamine 2, but also continuing to advance Mira 55, which we have written extensively about in the background. Now let's talk about our targets. Now back in February, we featured Mira on the show. We said that the stock was going to take off in a big way, and what happened? It certainly did. It went from under $1 to about $5 a share. You can see this is where we featured them on the show. It jumped up once, pulled back, jumped again, and then after a bit took off. Now Zach's saying this is going to happen again as we see the stock pull back right into support. You see this tan line? This is a 200-day moving average. This is a 100-day moving average. So we're seeing the stock pull back into support, and currently based on its trading price, looking to head, as Zach believes, to $16.50 a share. You can see a short-term move here would be a 50% move right up here to its 90-day volume profile line, putting this zone right here as support, an area you want to look to be buying, with the initial first target to sell up here at the volume profile line, then with the much bigger target of $16.50 a share for long-term investors. Keep a watch on the news coming out of Mira, as ketamine 2 could take Mira's stock to the moon. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.